So, given the increased emphasis on capital efficiency, how are you guiding companies in your portfolio on cash and expense management? Specifically, how do you recommend they balance extending runway and capturing market opportunity?
Yeah, thanks, Warren. I mean, this is obviously a really important topical issue that pretty much all of our boards are having discussions around it. A year ago, we weren't, no one was talking about these things. And so this is very much front and center. Typically, I mean, the easy things are to, and most companies are doing it, which is just looking for areas where there's, you can cut here and there, right? So not any, major strategic decisions. And I think pretty much all of our companies are going through that. That's kind of a no-brainer. I think the second issue that we kind of keep in mind is that, like at the end of the day, growth, at least for our portfolio, is the biggest value driver. And even, Christine had pointed out that rule of 40 has become more important, but growth is a component of that rule of 40. And so, we do need our companies to continue growing. However, the efficiency becomes really, really critical here. And so what we tell our companies, I think, depends a lot on the company itself, right? If the sales and marketing efficiency looks good for these companies, meaning that they're acquiring customers, there's a bit of a tailwind, maybe the product market fit is particularly good, or their competitive positioning is particularly good. We encourage our companies to keep investing in the growth of the business. And that we do see some companies where they're growing, but a lot of it, for instance, is through upsell. And so when we talk about efficiency, we do look very closely at new logo efficiency. So that's a factor in how we guide the companies. If their efficiency metrics are not good, then pulling back the burn more significantly to either buy time to fine tune their go-to-market or product, or even like an overhaul. That seems to be kind of the better path, I think, for companies that aren't seeing that efficiency, or for some reason the business just isn't clicking as well. And so again, it depends a bit on the business itself. The other key factor here too is just the valuation of the last round. I think the bigger the disconnect is between where that last round came in compared to where we think the company might price today, I think has also a big impact. So if it's a big disconnect, then we often tell our companies to really try to buy themselves much more time to build the business and hopefully grow back into that valuation.